Welcome. Many familiar faces here who have been to a number of these Investor Insight Evenings in the past, but for those of you who don't know myself, my name's Andrew Hewison, with my partner in crime, Simon Curtin. We're both senior advisors and directors of Hewison Private Wealth. Before we turn it on, rookie error. Just to cover off on the preliminaries, what we're going to talk about tonight is general in nature. So, if you'd like to speak specifically about your circumstances, you should touch base with your advisor. We'd be happy to continue the conversation. So, we've taken this topic off previous feedback, which you've got the opportunity to fill out this evening. Property and shares, I mean, they're two, catchphrases that generally spark a lot of interest, particularly with the investor market. The topic tonight, property or shares, where should you invest? As I said before, there's a lot of familiar faces in the crowd, and that's basically because you're all clients of ours, essentially, if you're not, welcome anyway. But then, if you are a client of ours, you would know that, part of the Hewison philosophy is that there's no right answer to this question. So we're not going to try and lead you down the path of saying one's better than the other. We're going to look at performance, we're going to look at appropriateness, and Simon and I are going to run you through a scenario later on where we've done our best to give you examples of where we think it's more appropriate to, from a timing point of view, sort of timing in life point of view, to invest in property or shares or a combination of both. So really the answer in its purest sense is it depends. It depends essentially on the objectives of the individual and what they're looking to achieve throughout the stages of their life. So as I said, it's an objective-based decision. So it depends on what it is that the individual is looking to achieve. Are they looking to achieve wealth accumulation? So they're looking to grow their wealth. Perhaps they're looking, so that might suggest that they're a younger person, they don't have a need for income from the investment, they're just looking to grow the value of the asset over time. Perhaps they're a little later in life, perhaps they've retired, and perhaps cash flow is more important to the individual. Perhaps it's a combination of both. We also need to factor in what the acceptance of investment risk is. Property and shares being growth assets come along with certain risks. The risks being positive and negative. The ability to make money and the ability for the asset to also fall in value. We refer to that as volatility. It's not until you actually sell the asset that you would ever realise a gain or a loss. So shares and property being growth assets bring a certain element of volatility that the individual needs to be comfortable with. In addition to that, of course, there's an issue around the time frame for investment. Typically, and we'll talk about this a little bit further in the presentation, but you would really need to have or be willing to accept an investment time frame of at least 5 years before you could consider investing in a growth asset, because any time frame shorter than that, you run the risk of the asset falling in value. You may then have to realise the asset and you may have to realise it at a loss without having enough time to see that asset recover in value. Perfect example, let's take the GFC. You buy an asset November 2007. It just so happens that you need to sell that in March of 2009, where that's essentially the bottom of the market. Whereas if you waited a few years longer than that, you're giving your asset the opportunity for its value to recover. Now, of course, when we're looking at the objectives, we can't just factor in the two asset classes in question tonight. We have other asset classes such as fixed interest, international investment or international exposure, and cash. And typically those that understand, I guess, the Hewison philosophy, we provide objective-based advice and objective-based strategies. So we look at the objectives of the individual, and then we look to factor in these asset classes where relevant. We're not going to go into detail in relation to these asset classes tonight, but they're worth considering. Now, we're making an assumption that essentially you understand the bare bones of what is a share and what is a piece of property. But just to step you through some features and fundamentals from my point of view with shares, and Simon will cover off on property. As I've said before, it's a growth asset. You're investing in an Australian company share because of its potential ability to grow in value and provide you with a positive return in the growth sense. Shares are easily valued. We all know that. They're, essentially in Australia, they're listed on the ASX, the Australian Stock Exchange. Sometimes to their detriment, you can value them a little too often, and it can play with you a little bit when times are a little more uncertain. But it is a key feature. It's a very liquid asset, and the disposal costs and entry costs as well are minimal. One of the beauties of shares is there's next to no outgoings. Once you've paid your brokerage, you can let that asset sit there. You can, as Warren Buffett would say, you can buy an asset and you can put it in the top drawer and let it sit there for 10 years with the hope that, or the expectation that it's going to grow in value. And along the way, there's basically no outgoings. They do provide a really good ability to diversify. Well, let's just say, for example, you've got $100,000. You could place $10,000 into 10 separate stocks and gain a diversification across many, many different sectors. Anything from retail, finance, healthcare, gaming, tobacco. You can get a very broad diversification for a fairly minimal amount of money. Now, the payment of reliable dividends, obviously it's very specific to the company that you select to buy and to invest in, but typically a quality Australian company share will pay you a reliable dividend which is fairly predictable over a period of time. And if we just use the example again, because it's so, I guess, fresh in the mind and such an important point in the share market's history being the GFC. If you take a bank stock throughout the period of the GFC, the banking sector as a whole reduced their dividends from the height of the market in 2007 to the bottom of the market. They reduced their dividends by only 25%. And the grossed up dividend, and I'll explain what that means in a minute, was something in the order of around 7 to 8%. So even throughout a financial crisis, these Australian company shares still paid reliable dividends, and to this day, the dividends that are now distributed from those companies are far outweigh or are far in excess of the dividends they paid pre-GFC. So they've recovered and continue to grow. Let's grab a glass of water, sorry. One of the absolute key features of Australian shares is the dividend imputation system. Essentially, a company pays tax on its profits prior to making a distribution to the shareholder, prior to paying dividends. The shareholder then receives the dividend, which they have to pay tax on, generally speaking, in their own name, marginal tax rates in a super fund of 15%. If the individual didn't receive the dividend, didn't receive a refund of the company tax that's already been paid, then the dividend would be taxed twice. So what many Australian companies do is they will provide the investor with an imputation credit, which is a refund of that company tax. Now, it's particularly powerful in a superannuation fund, and the company tax, as you can see out there, is 30%. Superannuation funds pay concessional tax of 15%. So in that situation, a superannuation fund is going to receive a 15% benefit. But some of you in the room, as I know, are drawing pensions from your superannuation funds, and therefore your super funds are not paying tax at all. So the beauty of the imputation system is that you would then receive all of that dividend imputation credit back into your fund as a cash refund. So if you're ever talking to your accountant about when they're going to finalise the superannuation fund's tax return, it's in your best interest to push them along a bit because the longer that it goes on, the longer it takes for you to receive that cash refund. A couple of examples here. National Australia Bank pays a current dividend yield of 5.8%, but it's 100% fully franked, which means it repays that imputation credit. 100% of the company tax gets refunded back to the investor, which provides a grossed up yield of actually 8.3%, which is, from an income point of view, on a growth stock, is actually really powerful. BHP is just another example. Doesn't have quite as high a payout ratio. It looks to reinvest a lot of its money to keep growing the business, so the company. So its yield is a little lower, but even still on a company like BHP at the moment, the grossed up yield's almost 5%. In terms of gaining exposure to Australian shares, there are many different ways to do it. Most of you would be aware of the Hewison philosophy, so to speak, but that's not to say that that's the only way to gain exposure. Our preferred mechanism is through direct ownership, and that is where either you individually or a family trust or a superannuation fund purchase individual shares in the company, and they're owned in that entity's name. Gives you complete, control and flexibility as to what you choose to do with the company or with the shares at any given time. I categorise the next one as direct managed. It's still a listed company. Australian Foundation Investment Company is one of the three majors. Argo Investments and Milton Corporation are another couple of examples. But essentially they are listed on the stock exchange, so they are a direct exposure, but their sole purpose is to own and manage a portfolio of other blue chip stocks. So you could classify that as a managed investment, but it's direct. You then have pure managed funds where you don't necessarily own the underlying company, but you own units in a particular managed fund, which is managed by a third party. In this example, Perpetual Industrial Share Fund is quite a well-known managed fund. And then we have exchange-traded funds down the bottom, and I've used the example of iShares. Essentially, again, listed on the stock exchange, but by purchasing this company or this investment, you can actually gain exposure to an index. And I've used the example down the bottom here. So via one share investment, you can gain exposure to the ASX 50, the ASX Top 100, or perhaps the ASX 200. Particularly valuable if you take the view that the market's undervalued, and as a whole, the market is going to appreciate in value. Simon, you're up.
Just as Andrew's given you an overview of the shares or share market, I'm going to do the same for property. Just talking about some of the fundamentals or features of property investment. Property in its simplest form is land with buildings or the structures that reside upon that land. What makes property such a popular investment, particularly in the Australian psyche? Property is, I guess, in many surveys, the more popular investment over shares because it's tangible. You can drive, you can see, I own that property, or own a portion of that property. You can touch it, you can feel it. Whereas for a share investment, it tends just to be a certificate that shows that you own shares in a company. It's understood. Similar to the tangible point, people understand how property works. We live in a property, we go to work in a property, people know what property is at a basic level. As opposed to, as I said before, with share investment, it can be a bit of the fear of the unknown or not knowing really how the market works. Less volatile. So the share market, as Andrew said, has its highs, has its lows, as we saw during the global financial crisis. Property too has its highs and lows, although it's not as advertised. You don't get the reports on the news each night that the property market's up or down 3 or 4 points. A common example that we like to point out is imagine coming home each night, neon sign sitting on top of your garage that shows you in dollar or percentage terms how much your property's gone up and down in value any particular day. You could imagine how stressful property ownership would be, similar to share ownership. Fortunately, we don't have that. You really only find out the value of your property when you buy it, and then it might be 10, 15 years again when you sell it. More often than not, it's gone up, so you sit back and think that's a great investment. But there's not that level of scrutiny over the investment as much. And land value is really the key determinant in property appreciation. I mean, when you've got any building sitting on top of land, that building over time is going to weather, it's going to degrade, so it's actually going to go down in value. It's the scarcity of the land that makes property prices go up, and it's no surprise that obviously land in the inner capital cities are more desirable, hence they're worth more money. As you're moving out of town, land values tend to go down because there's more land and I guess less people wanting to live out there. And the final, I guess, feature of property investment as opposed to shares is that banks will lend more against a property. When you go to purchase a property, the bank will lend sometimes up to 80%, sometimes a bit more if you weren't willing to pay extra fees, but typically they'll lend 80% against the value of the property. So with a $200,000 investment, you can gain exposure to $1 million property. With share investment, banks aren't willing to lend as much against the shares, so you don't get that ability to buy larger assets, so therefore you lose, or you don't get greater effects of leverage, so greater effects from borrowing, using the bank's money to grow your wealth. A couple of types of property that I'm going to touch on: residential and commercial, and the three subsets there we'll go into a bit more detail. Residential, which we'd all be familiar with, is the house that we live in, or we might have an investment property that we're renting it out. Typically, for an investment property, you're getting a yield or a rental return of around 3 to 4.5%. So that's the amount of rent you get versus the value of the property. Generally, you're leasing the investment property out, typically on terms of around 12 months. Sometimes you might get a bit longer, sometimes shorter, but typically you're getting around about that 12-month term. So you need to be factoring in, if you're going into a residential property investment, are there going to be periods of time where you can't find a tenant? How are you going to be managing the cash flow during those periods? And also, I guess, typically with a residential property investment, because the yield or the rental return isn't that high compared to other types of property investment, you're really relying on capital growth for the residential market. Commercial office buildings, we all know what they are in Melbourne CBD or in capital cities. Buildings that are intended for business use. As a result, you tend to get a higher yield, so you might get a 6.5 to 8% rental return. The flip side of that being, you don't expect to get huge amounts of capital growth out of a commercial property. And typically with property values, with a residential investment property, I suppose the forces of supply and demand come into play a lot more, with property prices going up and down, a bit of speculation. With the commercial market, it's a bit more of a sophisticated market, and typically values are driven primarily by the yield. So, for example, if you're on a 8% yield and you're getting a $200,000 rental income, or sorry, a $20,000 rental income, well then you might be getting it might be $1 million property. It's just working backwards to see what's the actual value of that property. So the actual yield you're receiving is very important in determining that. Industrial property, as the name suggests, is property that's for industrial type use. Typically, you'll find that is in the outer areas of a suburb or capital city. As a result, it's on larger blocks of land. People don't necessarily want to live around these areas. You'll find that land values don't rise as much in value, so you get compensated with that for a higher yield. You'll also get long-term leases with commercial, office, industrial. You're looking at around about sometimes 5, 10, even 15-year leases, so you're really locking in that cash flow for the longer term. And the final commercial property to have a look at is retail, which, as the name suggests, buildings used to sell goods or materials, shops, shopping centres, even around to your local milk bar. Very similar to a commercial office building environment, although obviously not as desirable because it's not in your type A areas. So I guess in summary, for a residential versus commercial, most people, when they're thinking of going into property investment, they'll be looking at a residential property investment, primarily because affordability. You can buy a residential investment property with 500, perhaps even less than $500,000. However, if you're moving into the commercial market, you're really looking at that $1 million plus, so it's not for everybody to go into commercial property. As I said, commercial properties are more valued on the quality of the lease and longevity of the lease, as opposed to with a rental or residential property, scarcity, supply and demand. Is it in a good location? Just going to talk about how you can gain exposure to the property market, because there's your typical one that we'd all be aware of, your direct property investment, where you actually go out and purchase an investment property, which, as I said before, could be $500,000, could be in excess of $1 million. Most people, when they think of going into the property market, that's what they're looking at. However, again, for most people, if you want to get a diverse portfolio, perhaps having a direct property investment isn't the wisest choice, because if you've got $800,000 to invest and $700,000 of that is one property, you're not really getting the benefits of diversification. So I guess to combat that, some other options are unlisted property trusts. Now, this is a type of investment where a trust is established, and investors will invest their money within the trust and buy units. So a number of investors, for example, a lot of our clients will be invested in unlisted property trusts over commercial properties. So the property itself might be worth in excess of $100 million. Clearly, nobody is going to go out and buy that one property, or we wish we could, but in reality, you can't afford to buy one $100 million property. So to gain exposure to a quality asset like that, you invest via a trust where you buy units. It might be a $10,000 investment, could be a $100,000 investment, and you get an underlying exposure to that property. So as that property goes up in value, then your units in the trust will also go up in value. The rental income that property generates will flow through to the unit holders. So it's a way to gain exposure to high quality property without the big outlays. And the final option is a listed property trust. Very similar to an unlisted property trust, however, this time the property trust is listed on the stock exchange. So you can actually go and buy, just like you can buy Australian company shares, you can buy shares in a listed property trust. Of the three, the listed property trust, while it does have property investments in it, it can behave very similar to a share. So it is subject to the whims of the market, the highs and the lows. And we saw during the global financial crisis a lot of listed property trust investments depreciate in value substantially, not necessarily because the properties they own were poor quality or had gone down substantially in value, but just because of the fear factor of the share market, everybody selling out. So the listed property trust values will fall as well. Just some figures here that I'm sure you'll all be interested in. Over a 10-year period to December 2013, as you can see, the share market returned 9.2%, as opposed to residential property at 6.1%. So it's a 3% outperformance. Now, I certainly wouldn't look at that and be suggesting go and invest in residential properties. Share markets will give you the best return, because when you look out over an extended period of time, after 20 years, you can see residential property actually outperforms shares. So I guess what I'm trying to convey here is there's no right or wrong answer. They're two snapshots in time. Interestingly enough, the share market in 1993, so just scraping into that 10-year performance, in 1993 the share market went up 40%. So that would go a long way to giving that extra return of shares versus property, and I wouldn't be surprised to see that come 10 years to December 2014, they'll be a lot closer, because that outlier of 40% in the share market gets moved out of the data. If we want to go back to the extremely long term, this graph here shows you shares versus property over a 130-year period. So as you can see, the blue line being the share market, red line being property, starting way back in the 1800s, all the way out to today, property marginally ahead. Again, does that mean property is a better investment? No, because it's all got to do with the time you purchase the property. But I guess the message to take out of that is that even over an extremely longer period of time, shares and property have performed relatively the same. So it really goes back to the benefits of diversification that we talked about earlier. Over to you, Andrew.
So just to finish off on before we dive into the case study, I just thought it'd be just a good sort of worthwhile slide to put up here is in terms of what will determine a successful strategy. It's not always about the asset class that we're choosing. I mean, there's a lot of other factors. The initial investment amount is obviously a huge factor. I mean, what exactly are you starting off with? And I put the example, or I put the sentence up there. It's much, you would have heard before, it's much easier to make your second million than it is to make your first. I mean, when we're dealing with percentage growth, you know, you start with $50,000 over a period of time, it doubles in value, you've got 100. Once that doubles in value, you've got 200. So the point being here, I mean, the more you've got, the easier it is from a compounding point of view to grow your wealth. Timing, look, it's not everything, but it helps. You know, GFC example once again. If you bought CBA, for example, at the height of the GFC for around $70, it has taken some time for CBA to recover that value. It's now ahead of that. It now trades at about $82. But had you purchased it for 30 or something like that at the bottom, at the depths of the GFC, obviously your return's looking a lot better. So we obviously advocate a much longer term approach so that the timing becomes less relevant. Time frame, they kind of are one in the same. The power of compounding, obviously plays a big part. Ongoing contributions, without them, a long-term strategy just got longer. So you've got that example of CBA. If you have ongoing contributions going into your portfolio, you may have purchased it at the height of the market at $70, but CBA had a share purchase plan at the bottom of the market for $25. If you have ongoing contributions and ongoing cash flow, it gives you a lot more flexibility to invest in markets when they're perhaps depressed. The outcome of that, of course, is that you're lowering and dragging down the average cost that you paid for that company. So when that company, such as CBA, starts to return its value, your break-even point is much, much sooner. A borrowed amount, we've sort of touched on it. Of course, that's the power of leverage. Borrowing can be appropriate in some circumstances. It enables you to potentially magnify the returns. Of course, it does provide the opportunity to magnify the losses as well. And I did mention before that concept of volatility, and you only ever realise a gain or a loss when you sell. So you need to be very careful and factor in that long-term approach. And of course, your investment choices. What are the objectives of the investment? Are we buying for growth? Are we buying for income? Or are we looking for both? So all of these, I use the example of CBA, but I mean all of these factors determine the difference between perhaps a good strategy versus a great strategy, whether it be shares or property. All right. So we're going to launch into a case study here. We're going to essentially take you through the life of Joe. We kick off, Joe is 25 years of age. He's managed to accumulate some savings of around $50,000. He's also got himself a pretty good job, and he's got surplus income of $2,000 a month. What's his objective? Well, he wants to buy a house, just about every other 25-year-old Australian. What's his strategy going to be? In this situation, obviously, $50,000 isn't really going to be enough of a deposit to purchase the property at this point in time. So we would look to recommend an investment portfolio into a diversified portfolio of Australian shares that pay those strong dividends that we talked about before. And we'd also encourage Joe to invest his surplus income on a monthly basis into the portfolio and continue investing that money.
Fast forwarding 30 years, Joe's obviously married to Jill.
5.
Alright.
I know you're keen to wrap up.
Joe's 30, married to Jill, moved out of home, built his share portfolio that's now grown to $200,000. So his $50,000 initial investment plus his $2,000 a month savings capacity into a share portfolio over a 5-year period has now grown to $200,000. Joe sells his shares and himself and Jill purchase a home for $750,000. So he's borrowing $550,000 with his $200,000 deposit to purchase his home.
Which is about 70% LVR, 70%. So he's already got wriggle room of 10%.
That's right. So at this stage, Joe's looked at share investment. It's been the most appropriate investment tool to get him where he is. However, now he wants to realise his dream, buy a home, start a family. So he's moving into the property market. Built up a sizable deposit. Now Joe's focus shifts to repaying non-deductible debt. And as I'm sure you've all heard before, when you've got the home loan debt, we want to pay it off as quickly as possible because we're not getting any tax advantages or concessions from having that debt. So Joe's focus now, he shifts that savings capacity plus the rent he was using when he was saving up his share portfolio, that now goes towards repaying debt. So as I said, yeah, Joe makes his standard repayments on a 30-year mortgage and directs $10,000 a year towards the loan. Now, these figures we haven't just plucked out of thin air. We've done some calculations behind the scenes. We didn't want to bore you tonight with spreadsheet upon spreadsheet, but we just plucked out the figures here. So that it is a real world scenario. We haven't just plucked these figures out.
Yeah, and the $200,000 value in the share portfolio is based on a 10% return, which we've pitched that at the more conservative end. The share market returns and the property returns that Simon quoted earlier, I'm assuming, correct me if I'm wrong, Simon, but they don't include dividends. No, so they're just purely growth, whereas 10% return includes growth and income. And yeah, obviously we've brought it back down to 10 because obviously home loan repayments are more expensive than rent, so he doesn't have, or they don't have as much of a surplus income as they did earlier on. So now we take it to Joe and Jill being 35 and they've got some young kids. Through the standard repayments that we talked about in the previous slide, they've now built up $300,000 equity in the home. Again, these are realistic numbers. The objective now is wealth accumulation. Specifically, I guess, with the priority being to provide future funding of future school fees. So our strategy now, we turn back to the share market. We started with shares, we've sold them, we've gone into property, and now we're using the property to leverage back into a share portfolio of quality Australian company shares.
Joe's 45, repaid his home loan, share portfolio now funding his school fees. So now he's at a point in his life, he's debt free, he's put in the hard yards, got himself into a great position. He's now focusing on wealth accumulation. So he's on the home stretch, so to speak. Retirement is not too long, not too far off, still another 15 odd years, but he's doing the right thing. He's starting to think about it.
70. See, under our strategy, he can retire a lot earlier.
When do the kids move out of home?
So Joe's come to see some great advisors at Hewison Private Wealth, and he's got a wealth accumulation strategy in place. He also wants to introduce some further diversification. At the moment, he's just been doing share market, property market. And at this stage in the game, we'd be looking to Joe to say, you've got a substantial asset, you've got no debt against that asset, time to move into the property market. Remembering I said before that the advantage of, I guess, property versus shares in this case is that the bank will lend a lot more against the property. So this gives Joe and his wife Jill an opportunity to buy a larger asset for using less equity within his home.
And the other thing, just to mention now, we obviously would want to keep things pretty simple for the purpose of tonight's example, but within that portfolio that is accumulated, they've accumulated over time, that's not to say that they might not have some international exposure, or they may not have a little bit of fixed interest in there to provide some kind of stability, strengthening cash flow and whatnot. But for the purpose of tonight, we're sticking with the property and the shares scenario. So Joe and Jill are now 60. They've accumulated sufficient assets to support their retirement. Their objective now is more of a shift. It's less around wealth accumulation. It's more now about providing for their retirement and their income needs in retirement. So they need strong cash flow. Their strategy, to create greater diversification via the introduction of some additional assets, such as fixed interest and cash. So we've used the tools, being shares and residential property to grow wealth, but now our objectives and our focus is shifting. May want to reconsider the types of Australian shares that we're looking at, perhaps some of the less growth orientated companies, some companies that pay out greater portion of their profits by dividends. And this is a time when, potentially residential property isn't as appropriate as what it used to be. When Simon talked about property and the characteristics of how residential property tends to provide higher growth and less income. It's now more appropriate for Joe and Jill to rely on the cash flow, so maybe they should be looking at some commercial industrial property over residential. So that essentially concludes the presentation. Of course, we're open to any questions. So if you've got anything, fire away. Yes?
Two questions about Joe.
Yeah.
One, was his original objective of buying a house, he was 25. If you can get over the emotional thing about I want to own a house, would you support that original objective as opposed to I'm happy to rent for the rest of my life and invest as an alternative?
Yeah.
And the second thing, did the case study assume that he was maxing out his deductibles for super throughout his